So with that, I will turn it over to Ron Zilka. Go ahead, Ron. Unmute yourself.
Good morning, everyone. As of yesterday, we officially have a new president-elect coming in here next month. And what does that mean for taxes? Next. Actually, the Senate really holds the keys to what will happen with taxation. At best, the Republicans will have a two-senator majority, and at worst, the Democrats will have control of the Senate. That, in turn, is where our issues are going to come in. Next. President-elect Biden has suggested a few big tax changes. The first being taxes going back to 39.6% for any income roughly over $400,000, married filing jointly. Right now, that is only at 35% until about $600,000, then goes to 37%. So the delta on that could be very huge. He's also would like to limit certain itemized deductions. One in particular I heard about was taking the mortgage interest deduction down to a total rate of 28%, regardless of the marginal tax rate you are in above that. Another surprising one was to add back OASDI. That's the 6.2% of the Social Security that you pay on wages. That anything over wages over 400,000, that tax would be taken out again. And here a real big one: 39.6% capital gains on all gains over $1 million. Now that sounds like a lot of money, but if you sell your company, you sell it for over $1 million, you in essence be given 50% if you live in the state of Minnesota to the government on the sale on cap gains. And also I talked about the reduction of the estate tax exemption. Now that's going to be covered later, so I'm not going to go any more detail on that. Next. Okay, the general rule we've always followed for years were defer income and accelerate deductions. Well, the reality is the taxes are never going to be lower than they are right now. Now, whether they stay at this rate for 21, 22, we don't know, but we do know that 1/1/26, all these tax provisions expire. So we go right back to where we were in 2017, which is back to the 39.6% bracket and other other changes. Next. Instead, maybe we should think about accelerating income in 20, maybe 21, and deferring deductions out. For example, would be generally we all like to take bonus depreciation of 179 on our assets that we buy in the current year and expense them. Maybe that's not a good idea. If the top rate goes from basically 35 to 37 to 39.6, those deductions may have a better use for them in the future. Next. Some practical tips would be conversion of a Roth. Depending on how far you are to retirement, but you would be locking in at a potentially lower rate by converting it in 2020, possibly 2021. And then, of course, at least under current law, not having any tax on the gains afterwards. Harvesting some gains in 2020 here. Obviously, netting them with the losses. You'd have to talk to your financial advisor about that, but that's a plan. We just discussed depreciation planning. Exercise non-qualified stock options if possible. Again, getting them to a lower bracket. And another thing to think of is the accounting method change. If we're on the cash method, maybe better off going back to accrual method to pick up some of that income in the lower tax brackets. Next. Thank you.
Okay.
Ready, Laurie?
Yep, I'm ready.
Okay.
My topic is PPP, which those of you who receive PPP loans know what I'm talking about, and those of you that didn't, it might be a little bit new, but I'm just gonna kind of skip sort of the history because I think most of us know that, how crazy it was. So things that we're talking about right now is, one, is it time to apply for forgiveness? Some of you may have already done so, others may not have. And I know as of a few days ago, I still had clients whose banks still weren't ready to take applications. Now, in my opinion, that's okay. There's no rush. I've been advising most clients, unless there's a compelling reason otherwise, that we wait in hopes that there will be more clarification and simplified procedures. Right now, we have a simplified procedure for loans for 50K and less, but in legislation, there's ongoing discussions around that number moving to 150,000. There's a current proposal out there that the belief is that probably has a pretty good possibility of becoming law. Of course, we can never predict that. The other thing that we're still waiting for a favorable answer on is deductibility. So, I mean, I've really been advising people there's no rush, let's wait. You have plenty of time. Basically, you just need to apply within 10 months after the last day of your covered period. So if your covered period ended on October 30th of 2020, you have until August 30th of 2021 to apply. And that's before the loan repayment begins. So there's no rush. I mean, I've had some clients where the banks are pushing, I think, for them to fill the applications out. But it appears to me that that's more of an internal desire for them to kind of get this behind them. Then there's nothing that would require people to do that now. So, and again, the other thing is non-deductibility, which we're hoping for a favorable answer on. Next slide, please. So the CARES Act specifically excluded the debt forgiveness from income, but the IRS has come out with a number of notices or revenue rulings. The first one was 2020-32, which basically said, if your expenses, if the loan gets forgiven, you can't deduct the expenses that you use that loan to pay for. So that was sort of surprise number one. And then fairly recently, they came out with a revenue ruling, which basically clarified the year for which the deduction would be disallowed. And I think that was not totally unexpected, but not really, again, what we were hoping for. So if your expectation is forgiveness, even if you have not applied for forgiveness, or you have applied and you're still waiting for an answer, but let's say you don't get the answer till 2021, then basically what this ruling said was the expenses are non-deductible in 2020. So even if you get forgiveness in 2021, it's still, you can't deduct those expenses in 2020. So if you're expecting forgiveness, that's your expectation, then you can't deduct the expenses in 2020 as things stand currently. So what's going to happen? So let's say we get into next year and we still don't have a favorable answer, which I certainly hope is not true. What do? So the due date of your return comes up. First of all, you got to kind of look at your year-end planning and sort of look at both scenarios so that you're prepared. But then when extension time comes, probably a good idea to extend, unless you feel, or we feel, that it's certain that this law won't get passed into, that this provision won't get passed into law. Now, that being said, there are some court cases out there that could be a basis for deductibility. And I think the expectation is, if the law never changed, that someone who has a PPP loan on millions of dollars will litigate this in tax court. So the other thing, just to remind everyone, is that the AICPA has a tool that can help you with putting together your forgiveness package and also looking at, your expenses. Next slide, please. So just so everyone knows, in December 1st of 2020, the SBA released all of the PPP loan information. So that's all public information, has names, addresses. This is not unexpected. And I guess the only thing that I would just say to people is, it's possible that, you know, there'll be firms that might see your name, that you might get solicitations for, hey, we can help you with the forgiveness, we can help you with certain things. And I would just encourage everyone to just, you know, be careful about that. I would first talk to, you know, obviously your banker is a good source of help, and of course your CPA. Next slide. So the other thing that happened was there's this loan necessity questionnaire. This is for loans that are 2 million or over. This will come from the bank. So if you apply for forgiveness and you fall under this category, then you're going to be required to fill out this form. This questionnaire does not mean that you will not receive forgiveness, but this is true for all loans. You know, you should have documented your thought process and discussions at the time of application, kind of your story, because at the time these loans were being, you know, given out, nobody knew what was going to happen. I mean, really, you didn't know what was going to happen with your business, how long you might have to be closed if you had to close. And the question was, current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. And the purpose of this loan was to keep people employed. So in my mind, this is another reason the AICPA has written letters. I mean, we really feel like this questionnaire needs to be modified or a little more guidance in that. So that's another reason to wait. Next slide. So what might happen?
Question on timing, Laurie.
Okay.
Okay.
Should I quit or talk fast?
Talk fast.
All right. What might happen? Because this is probably the best part. PPP2. There's a Senate Gang of 8 proposal. As of today, the bill might get split into 2 pieces, but it still looks like it's a good possibility. There's more money for SBA. 2 groups of people that would be eligible: hard-hit borrowers, probably defined as 300 or fewer employees, and who have a revenue loss. Could be 30%, could be 25 to 35. We don't know all the answers yet. Also, people who perhaps at the time didn't think they would need the loan, but things have changed. So new borrowers can also get loans. 501c6s also, subject to some criteria and the possibility of other criteria. Next slide. So just, you know, a lot of the requirements are going to be the same. They might add some additional costs that might qualify, like PPE, and if you had to modify your facility. And this provision right now has deductibility in it, that the expenses would be deductible even if the loan is forgiven. So I guess I would just advise people, be ready, because when it happens, it'll be like the last time, that it all happens fast. Next slide. So just some resources. Next slide. And now Jen.
Good job.
All right, thanks, Laurie. Always hard to follow the PPP expert, as that I think is the hottest topic in our industry this year, and probably will be going into next year. So I'm going to follow with some fun payroll stuff that may or may not apply to a lot of people in our group here. But there was a lot of different things that happened with payroll, and as we were trying to narrow down what to discuss in this group, I decided to go with the topic that's kind of been the most asked recently with my clients, and that is the Family First Coronavirus Response Act and the credits that relate to that act. I think with this second spike of COVID here in Minnesota, I feel like more companies are being hit with more people being out related to COVID, with more cases, more exposure, and everything else. So I think that's why this is kind of coming into play now later in the year for us versus earlier in the year. It was enacted in March and was effective starting April 1st and goes through the end of the year, December 31st, for time taken off for leave. So this act includes two different types of pay: emergency sick pay and then emergency family and medical leave pay. And basically it provides paid leave for employees that are out due to COVID-related items, and the businesses are reimbursed for those expenses almost dollar for dollar using two different tax credits. Next slide, please. The first credit is the sick and family leave credit. Employers, this applies to employers with fewer than 500 employees and all government employers regardless of size. There's three different buckets of pay or leave time that you can put things into. The first one is when the employee is actually the person that's sick. And it's listed there. They're unable to work because of a federal or state quarantine that's been issued, or they've been advised by a healthcare provider that they need to self-quarantine, or they're actually experiencing symptoms of COVID-19 themselves, or seeking a medical diagnosis. Those employees get paid their regular rate of pay up to $511 per day for up to 10 days or 80 hours. So a total of $5,110 is what that person can get paid for being out for those up to 2 weeks. Next slide, please. If on the other hand, someone is out not because they're sick themselves, but because they have to care for someone with COVID, they are entitled to 2/3 of their regular pay, up to $200 per day for 10 days or 80 hours, so up to $2,000. If they're unable to work because they're caring for someone with COVID, they're caring for a child because the child's school or daycare is closed, or their child care provider is unable to work due to COVID-19. So there's a group that's the 2-week period, and then there's an extended period, which is the second bullet, bigger bullet there, which is the caring for children due to daycare or school closure. That same rate of pay, the 2/3 of your regular pay, up to $200 a day, can extend 10 more weeks. If you are unable to work because you have to care for a child whose school or daycare provider is closed due to COVID. Next slide, please. So how this credit works, basically the credit is reported on your 941, your quarterly 941, and I believe every quarter this year, the Form 941 has been adjusted and fixed and updated. So every quarter there's been different changes to that form. So it's really important to make sure that you're looking at that to make sure that it's reporting everything correctly. The credit includes the wages like we talked, whether it's the $200 max per day or the $511 max per day. The employer also gets a credit for their portion of the Medicare tax, the 1.45%. And then they also get a portion, a credit for the pro rata share of employers' medical expenses related to that person. And there's a big convoluted math calculation that goes into that. So if you're someone that needs to make that calculation, I'm happy to kind of walk through that or talk to you about that separately. And I noticed when I was putting together the slides that these are the things that the credit includes. But there was no mention of the Social Security tax. And I was like, well, I know that they don't have to pay the Social Security tax. And what I found is that those wages are just considered qualified wages. And so they're exempt from the Social Security tax, the 6.2% for the employer, not the employee. All the taxes are paid by the employee just like normal, but this is on the employer side. So when you fill out your 941, there's actually two buckets. One bucket that's for your wages that are for everything that's subject to Social Security tax. And then there's a bucket for things that are not subject to the Social Security tax. So the employer really is not paying any of the Social Security, Medicare tax, or any of the wages. These items are all put together on your 941 and you're given a credit against any of the other employment taxes that you have to pay. You could also, if it was earlier on in the year, it might have been worth it for you to ask for a credit on Form 7200, but now with us being later in the year, it's probably not quite as worth it to do that form as this is expiring at the end of the year. Next slide, please. So the second credit related to the Family First Coronavirus Response Act is the Employee Retention Credit. And this is for employers that keep their employees on payroll even when they're having an economic hardship. So it basically means you're paying someone to work, but they're throughout this whole thing, even though you might be having some hard times, but they're not sick. So it's not as if they're home due to coronavirus. You're just continuing to pay them out of the goodness of as being an employer. The biggest bullet point on this one is the second one, which basically any employer that took the PPP loan is not eligible for this retention credit, which eliminates quite a few of our clients because a lot of our clients receive that PPP money. So I didn't go into a lot of details on this credit because it doesn't apply to so many people, but in general, the credit is very similar to the previous one. It's 50% up to $10,000 of qualified wages during basically that same time frame from March to December. However, you do have to show that you had economic hardship. And again, this is an even more convoluted calculation, but basically you have to show that by either having full or partial suspension of your business operations, or you have to have a significant decline in gross receipts. And significant is defined in the credit information, but it's very more detailed than what we wanted to get into right here. So my biggest takeaway on the payroll side of things is that if you have a payroll company that's helping you with your payroll, that's great. My understanding is that there has been big bullets and big words and bright stuff all over the screens to make sure that if you do have this situation, there is a special code for you to use for either one of these types of pay so that it's getting put into the software correctly. You don't want a situation where you're just going in and just continuing to pay people on a normal basis and then at the end of the year having to go back and fix things. So if you're noticing things now, it's good to fix them right now versus waiting too much longer before W-2s are issued and different things like that. So definitely take a look. If you're doing your own payroll, I would definitely maybe reach out, get some help this quarter because it's a little bit more difficult than it has been in the past. So thank you.
We have one question that we're going to hold till the end. So we're going to move into Dana, if that's okay, Nancy. And some of you will remember Dana from when she was here. She moved out of state, and now she's still out of state, but back with SDK. And because of the world of virtual, she gets to present, which I know she was very excited for. So take it away, Dana, and be sure to unmute yourself.
Yes, I believe I did. Yes, I am currently unmuted. Great. So today I'm talking about the CARES Act, which was a $2.2 trillion economic stimulus bill passed by Congress and signed into law by President Trump in March this year to help with the COVID-19 pandemic. So as you know, we did just speak about the loans with Laurie. So that was one of the big things that the CARES Act helped. And they also gave us the stimulus payments that you might have gotten this year. But there are also some important tax provisions that I'm going to go over. The first one I'm going to talk about is the favorable NOL carryback provision. So it allows net operating losses from 2018, 2019, and 2020 tax year to be carried back for up to 5 years, resulting in a potential retroactive tax refund. It also increased the tax deduction for NOLs from 80% to 100% for your 2018, 2019, and 2020 tax years. So it might be important to talk to hopefully your SDK advisor about if you'd be better off carrying the losses forward or back. The answer always depends on your situation, but SDKers can help with that. Next slide, please. The CARES Act also suspended what's known as the excess business loss, which was where there was a $500,000 limitation for married filing jointly and $250,000 if you were single on tax deductible losses. And so basically this has been extended until 2021 and is good for tax years before 2021. So you should take note if you did have excess business losses that were limited in 2018 or 2019. Talk to your tax advisor to see if we should amend your return for a potential tax refund. Next slide, please. The CARES Act also modified the business interest limitation. And this limitation was from the Tax Cuts and Jobs Act in 2017 that limited business interest expense deductions to 30% of the adjusted taxable income. But luckily, the CARES Act has now reduced that limit to 50% of adjusted taxable income for tax years 2020 and 2019. So guess what? If you did have this limit in 2019, you may want to talk to your advisor for a potential amendment, maybe get another refund. Next slide, please. Now, this next provision is essentially a fix of a snafu that Congress made when they were drafting the Tax Cuts and Jobs Act at the end of 2017. They were hurriedly trying to get it done before the beginning of 2018. So under the TCJA, qualified improvement property was supposed to have a 15-year cost recovery period, and then that would make it eligible for 100% deduction through bonus depreciation. But the drafting error caused the qualified improvement property to have a 39-year life, which made it ineligible for the 100% deduction. The CARES Act fixed this error and made the 15-year life retroactive to property placed in service on or after the first of the year in 2018. So once again, this tells you that you might have a chance for a potential refund or something like that. There was a revenue procedure that the IRS released not too long ago, 2020-25, providing some guidance on just how taxpayers could fix this error in their 2018 or 2019 returns. And depending on your circumstances, you could potentially file an amended tax return, or you might have to file what's known as a change in accounting method. But, you know, as usual, SDKers are here for you if you need that done. Next slide, please. Okay, so finally, a provision that was good for taxpayers and charities. Individuals who take the standard deduction can now take a deduction for up to $300 of cash charitable contributions per year beginning in 2020. And those who itemize, the Act actually increased the limit for most cash charitable contributions from 60% to 100% of your adjusted gross income for individuals. So this essentially means that an individual, if they want to contribute 100% of the amount of their adjusted gross income to a charity of their choice, then they could actually have no adjusted gross income for tax purposes, whereas normally that would be limited to 60%. Corporations' limit on deductible charitable contributions was also increased. Like I said, a great provision for both individuals and corporations and for the charities, so win-win all around. So my tip here is just, you know, nothing really SDK can help you with unless you want our tip on who to give donations to, but get your donations into the charity by the end of this year. So you have, you know, a couple weeks left to do it, and if that's something you're inclined to do, go for it. You can get a tax benefit. So the CARES Act was all about giving more cash to people and getting more cash into the hands, if not through loans, direct payments, or tax refunds. So just talk to your SDK advisor if you'd like us to look into any of these provisions. We don't want you to leave any cash on the table if possible. So next slide. Okay. Now to Nicole Brown to discuss retirement.
Good job, Nicole. Dana, thank you, Nicole. I just posted the link to our website that has the slides. A couple people have asked where they are. So if you still haven't, if you didn't get the email yesterday, or if you're looking for them, they are on our website. So I posted the location.
Okay. There have been a lot of changes in regards to retirement and IRA in the last few years. Unfortunately, I don't get much time to go through them all, so I'm going to go through the most important ones. If anyone has questions about stuff that I'm not going over, feel free to reach out to me later. Next slide, Linda. Okay, the first changes I'll go through, the required minimum distribution changes. So there were two acts that significantly changed these required minimum distributions. The first act was the Secure Act, which was passed in 2019. And what that did was it increased the beginning age for RMDs to 72. So what that means is if you were not age 70 and a half on December 31st, 2019, you do not have to start your minimum distributions until age 72. If you were 70 and a half prior, you have to use the old age 70 and a half. This also eliminated the stretch provisions, which I know Deanna will go through later, so I won't get into those. The next act, the CARES Act, which was passed in March, actually took away the requirement to take an RMD in 2020. For a majority of the defined contribution plans and IRAs, I will say though, defined benefit plans are still required to take an RMD, so those plans were not part of the exemption. If you have a question on which plans are exempted, please feel free to reach out to me. And also gave relief for those that already took their RMD. Some people take their RMD early in the year and they'd already taken their 2020 RMD. And if they would have known of these rules, they wouldn't have taken it. So it actually gave them some time to get those distributions back into their retirement plan. They had until August 31st. Next slide, please. The CARES Act also came out with CARES Act distributions. What this did was it allowed distributions of up to $100,000 for qualified individuals. And they were allowed to be taken from eligible retirement plans and also IRAs. These distributions must be taken between January 1st, 2020 and December 30th, 2020. So who's a qualified individual? A qualified individual is someone who meets any of the following bullet points. The first, you, your spouse, or your dependent is diagnosed with COVID-19. The next bullet point, you experience adverse financial consequences as a result of being able to work due to lack of childcare. They actually expanded this bullet point. It is no longer only you, it's you, your spouse, or a member of your household experiences adverse financial conditions. Same thing with the next bullet point. They expanded this to you, your spouse, or a member of your household has experienced financial consequences as a result of being quarantined, furloughed, laid off, or a reduction of hours. And they also added in that you had a job offer that was rescinded or your start date had changed. The last bullet point, you, your spouse, or a member of your household experienced adverse financial consequences due to the close or reduction of hours in a business that you own or operate, so self-employment income. Next slide. So if you were a qualified individual and you did decide to take up distribution of up to $100,000, the CARES Act waived the 10% additional tax that applies to early distributions. What this means is if you took one of those CARES distributions and you were under the age of 59 and a half, you do not have to pay the 10% penalty on that. It also waived the mandatory withholding. Usually if you take a distribution, the plan sponsor or the IRA sponsor is required to withhold 20% for federal withholding. That is not a requirement on these distributions. It also gave you some different taxation options. So when you take this money, you get to elect whether to be taxed on all of this money in 2020 or to spread it ratably over the next 3 years, 2020, 2021, 2022. It also gave you the ability to repay all or a portion of this distribution back to that plan or another plan in order to escape taxation. Now, let's say you already picked up part of that distribution in income prior to it being repaid. You would have to amend tax returns to get that benefit back. Next slide. The CARES Act also allowed some plan loan changes. These were for qualified retirement plans sponsored by employers. It increased the loan limit from March 27th to September 22nd to $100,000, 100% vested balance. Used to be 50,000 or 50% vested balance. It also delayed the loan repayments from March 27th, 2020 to December 31st, 2020 for up to a year. These are optional provisions which do not have to be allowed by retirement plans. So you would have to check with your plan sponsor if you're allowed to do these. Next slide. Another important provision is one of the Secure Act provisions, which is going to force employers to give some benefits to long-term part-time employees. It has always been traditionally that plan sponsors could exclude participation of employees based on working under 1,000 hours. That is no longer the case. Starting 1/1/2021, you will have to start counting credit for these long-term part-time employees. The earliest that these employees would get into your plan is 1/1/2024. These employees, in order to get in, will have to have at least 500 hours of service in 3 consecutive eligibility periods. So if you start counting and these employees have 500 hours of service or more in 21, 22, and 23, they will enter your plan in 2024. You're still allowed to use age 21, so anyone under 21 you can exclude, and you can use your standard entry dates if you use monthly or semi-annually. Next slide. So the Secure Act requires that you allow these employees to participate in the 401k portion of your plan. You are not required to give these employees employer contributions, including safe harbor or top heavy minimums. You do not have to give them vesting credit. You also don't have to include them in testing, but you must allow them to participate in the 401k portion. So it's very important if you have a retirement plan that you start counting this service starting 1/1/2021. Next slide. The Secure Act also had some retirement plan tax credits. So if you started a new plan in 2021, you may be eligible for these. The first credit isn't new, but it was expanded by the Secure Act. This is a credit for startup costs for newly established small retirement plans. The maximum credit is $5,000 per year. You can take it for 3 years. So if you started a retirement plan, you should definitely reach out to me or your tax person to discuss what amount of credit you're eligible for. The other credit is an automatic enrollment credit. This is for new plans and existing plans. This allowed people that added in an automatic enrollment feature to get a $500 credit. It's also good for 3 years. Next slide. So just some random year-end planning tips related to retirement. As Ron said, you should really consider Roth conversions. If this is a year that your income is down or maybe you have a business loss, this might be a good year to do it. You can still contribute to a traditional or a Roth IRA. The deadline is April 15, 2021 to get a 2020 contribution in. And also, because of the Secure Act starting in 2020, even if you're 70 and a half, you're able to contribute to a traditional IRA if you have earned income. That was something that has never been allowed. You can also establish a SEP plan. That can be established up to the due date plus extensions of your 2020 tax return. The same goes for a profit sharing plan. So the Secure Act changed that. It used to have to be in place by December 31st. No longer. It's up to the extended due date of your tax return. You also have time to contribute to an HSA and to max that out. The limits are down below. You have till April 15th to contribute that. Next slide.
Time warning here.
Oh, okay, this is my last slide. This is just a slide that shows the maximum limits for 401k plans, IRA contributions. If you have not contributed the maximum yet, you still have time to do so. 401k, obviously you'd have to have it in by December 31st. If you have any other questions, feel free to reach out to me. Otherwise, we'll move on to the next speaker.
Thank you, Nicole. Next up is Deanna. Take it away.
I'm Deanna Staeheli, and I'm going to talk to you about estate, gift, and trust updates. Next slide, please. So first off, gift taxes. The annual exclusion remains at $15,000 per year per individual for 2020 and 2021. The important thing to remember here is that medical and education expenses are exempt from gift tax as long as they are paid directly to an institution. In addition to the annual exclusion, a person is also allowed a lifetime estate tax exemption. Next slide, please. For 2020, the lifetime exemption was $11,580,000 per person. That increases for 2021 up to $11,700,000 per person. And that amount is portable to your spouse if an election is made on a federal estate tax return. The Minnesota exemption remains at $3 million. This is not indexed for inflation. There has been some discussion at the Minnesota legislature to increase this amount, but as of yet, nothing has really taken hold. Assets also currently receive a step up in basis to date of death value. Next slide, please. But as Ron was saying before, there are some proposed changes that are out there. So one of these proposed changes is to decrease the exemption amount to $3.5 million per person. Again, this would be portable with your spouse if that election is made, so a total of $7 million per couple. Another proposal would be that assets would no longer receive a step up in basis to date of death value. So the decedent's basis would carry over past date of death. Administratively, this is extremely difficult. It's very hard to figure out what grandpa paid for stock as he received shares in every paycheck during his career. Next slide, please. So we're going to look at an example as to how these changes could impact a $15 million estate. The decedent had a $2 million basis in these assets. So if there are no changes, the federal estate tax would be about $700,000. The Minnesota estate tax would be about $1.7 million, and there would be no capital gains if we assume that the assets are sold shortly after date of death. If the estate tax changes that we just discussed both take place, the federal estate tax would increase to $3.9 million. The Minnesota estate tax would stay the same, and capital gains would be about $3.9 million. And this is before the possible increase in capital gains that Ron mentioned at the beginning of the presentation. So this is a whopping $9.5 million of taxes that would be due. Next slide, please. There's a huge $7 million difference if both of these proposed changes are enacted. If only the estate tax changes, the increase in tax is $3.3 million, but that is still a significant amount. Next slide, please. So what should you do? If you're a Minnesota resident with an estate between $3 and $10 million, I would ask you to consider your marital status. What estate planning have you already done? You may want to consider making gifts, depending on your situation. So if you're concerned about this, talk to SDK and your other advisors. Anyone with an estate over $10 million, I definitely suggest that you talk to SDK and your other advisors to see what you should do. Next slide, please. This is especially important because the Secure Act changes the way that retirement accounts that were inherited during or after 2020, it greatly decreases the amount of time in which those assets must be paid out. So this is what Nicole was referring to when she said the elimination of the stretch IRA. So it is important to note, though, that if a participant or owner died before 2020, the old rules will remain in effect until the death of the current beneficiary. Then the new rules will come into place. Next slide, please. So these new regime set up a new class of beneficiaries called an eligible designated beneficiary. So the types of eligible designated beneficiaries are your surviving spouse, an individual that's not more than 10 years younger than the employee, a chronically ill or disabled individual, or a trust for someone with those conditions. An employee's child that is under the age of majority is also an eligible beneficiary. This age varies by state. It's usually 18 unless the child is a student, then it can go up to age 26. And funds must be distributed within 10 years of the child reaching the age of majority. So at the oldest, the child will have received all of the retirement funds by the time they're 36. This isn't usually the effect that we hope to have with our retirement funds. One important thing to note is this does not include stepchildren, nieces or nephews, or grandchildren, so only your own children. Next slide, please. So as I said, this chart kind of goes through the rules. The eligible designated beneficiaries are still allowed a stretch to an effect. Other designated beneficiaries, such as an individual that doesn't qualify as a designated beneficiary or a qualifying trust, will be paid out over the 10-year rule. If you have a non-designated beneficiary, which would include your estate or non-qualifying trust, the payout timing is even faster. Next slide, please. So this slide is just some terms to refer to as you're looking at that slide. It's just here for your reference. So next slide, please. So for trust, there haven't been a ton of changes, but if any of the other tax changes are made that Ron was referring to, trust would be impacted by that. We're continuing to monitor CEBS issues as a result of changes from recent state and federal Supreme Court rulings. And Minnesota and trusts are also impacted by nonconformity issues with Minnesota that Ryan is going to discuss next. Next slide.
Good job, Deanna. Thank you. Last but not least, Mr. Churness.
Everyone, I know Beth wanted a Minnesota Vikings joke, which I normally do, but I thought this was appropriate. In the mail from my sister, the holiday card that I got, there was a refrigerator magnet, and that magnet said, "I'm glad I learned about parallelograms in high school math instead of how to do my taxes. It comes in so handy during parallelogram season." So I thought that was perfect for our topics.
That's pretty
Okay,
good.
so
Pretty good.
moving on. Good afternoon. There have been 6 federal tax bills enacted since January of 19. When federal bills are enacted, it leaves the states with the task of deciding, 1, should we follow the new federal rules? 2, should we simply not follow them and keep our old rules? Or 3, should we have some type of modification to their rules? So that being said, my presentation for today is to inform you of recent Minnesota legislation, discuss Minnesota conformity, or more like non-conformity, and explain how these changes or non-changes will affect the Minnesota taxpayer. So let's get started. I thought the best place to start was to begin with the one new law that Minnesota did enact. This law is centered around Section 179 depreciation. If you're not familiar with Section 179, it allows businesses to deduct the full cost of capital assets, such as equipment, immediately rather than depreciating them over their useful life. In the past, Minnesota required a business to add back 80% of the federal deduction. That 80%, which was added back in year 1, would then be subtracted from income evenly in years 2 through 6. So it took a full 6 years to get a complete deduction in Minnesota compared to immediate expensing in year 1 for federal purposes. So the new law eliminates the requirement to add back 80% for taxable years starting in 2020 and thus conforms to the federal treatment. As an example, let's say your business takes Section 179 depreciation on $200,000 of new equipment. Under the old rules, Minnesota would require you to add back 80% or $160,000 to taxable income. That $160,000 of income would result in Minnesota tax of approximately $16,000 if you were in the highest bracket in year 1. In years 2 through 6, the business would get a deduction of $32,000 each year and save of about $3,000 each year. And now, under the new law, there's no requirement to add back the 80%, and thus businesses would save the $16,000 in tax immediately. Before the law changed, there wasn't much difference between taking 179 and bonus, 100% bonus, because they both required an 80% add back for Minnesota. So now the 179 will be more valuable due to the elimination of the add back. Another Minnesota topic to bring up is regarding the Paycheck Protection Program. Those are the PPP loans. Currently, under the IRS interpretation, any expenses which are paid using PPP funds are not allowed as a deduction in 2020 if the loans are forgiven or expected to be forgiven. And currently, Minnesota is following this interpretation and thus the expenses will not be deductible. If federal legislation passes to allow the deduction for those expenses, we don't expect Minnesota to follow suit. As a result, those expenses won't be deductible for Minnesota purposes regardless. Next slide. My last topic for today is to discuss Minnesota's nonconformity with federal legislation. Other than the 179 change just mentioned, Minnesota did not pass any conformity legislation in 2020. And as a result, Minnesota will require adjustments if you take advantage of federal legislation enacted. A lot of these topics I'm going to quickly cover are the ones that Dana had gone over in more detail. So the CARE Act changes for federal. For federal, as Dana mentioned, allows a 5-year NOL carryback and up to offset 100% of your taxable income. Minnesota will not allow a carryback and will only be able to offset 80%. For federal, they eliminated the $250,000 or $500,000 limit on excess business losses. Minnesota is still going to limit you. For federal, they increased the interest expense limitation from 30% of adjusted taxable income to 50%. Minnesota is still going to use the lower 30%. For federal, they fixed the depreciable life of qualified improvement property to 15 years and the ability to elect bonus depreciation. Minnesota still requires a 39-year life, although you could do a special Minnesota 179 election on that. For federal, there's COVID-19 IRA distributions, which could be spread over 3 years. Minnesota will not allow that spread. For federal, there's an above the line deduction for $300 for charitable contributions for people who don't itemize. Now, Minnesota is not going to follow that rule, but they do have their own rules related to some charitable contributions for people who don't itemize. And federal, for cash contributions, now you can deduct up to 100% of your AGI, and Minnesota was still going to allow only the lower 60%. So as you can see, even though Minnesota didn't enact much legislation, there's still going to be a lot of work necessary to get to Minnesota taxable income correctly. Because Minnesota's starting point is to calculate taxable income begins with the federal taxable income, there will be many adjustments for those who are taking advantage of the new federal provisions. That's what I have for today.
Nice job, Ryan, and 2 minutes to spare. Does anyone have questions? I did forward one on to Jen that she can answer, and as I said earlier, if you need to hop off at 12:30, that's just fine. If you'd like to stick around and ask questions, all the speakers will still be here. You can also call us. I've sent out the link to a couple of folks right off our main homepage, sdkcpa.com. If you can find information on the tax update, click on that, and that's where the slides are. You can stop sharing. Are there any questions?
So just we're eligible for Social Security benefits. And the answer is no. Everybody, as an employee, you are still paying into your Social Security. You have not been exempted from having to pay the Social Security tax related to your wages. So you still get credit for your wages towards your Social Security benefits in the future. So thank you for that question.